Hello to everyone. Today I am here with Introduction to Corporate Finance, Financial Planning and the Growth Part-6. If you are interested to have update videos on banking and finance related topics, please do subscribe my channel. In this session, we are going to discuss estimation of projected balance sheet. Estimation of projected balance sheet, external financial need. Estimation of projected balance sheet, external financial need example. Estimation of projected balance sheet, external financial need calculation. Estimation of projected balance sheet, express the balance sheet items that vary with the sales as a percentage of sales. Now it is very important. There are some variables having the direct relation with the balance sheet variables. So they will vary directly with the change in the sale. On the other side, multiple percentage determined in step 1 by projected sales to obtain the amount from the future period. No percentage applied, simply insert the previous balance sheet figures into the future period. If all the variables which have not direct relation with the sales or having no impact on the sales growth, those variables used to be carried forward as it is. Computer projected retained earning, present retained earning plus projected net income minus cash dividend. So from here, we can have a figure for the projected retained earning. Add the asset account to determine the projected asset. Next, add the liabilities and the equity accounts to determine the total financing. Any difference is the shortfall. This is equal to external financial need. Again, add accounts to determine the projected asset, add the liabilities and equity accounts to determine the total financing. Any difference is the shortfall. That shortfall is met through the external financial need. Use the plug to fill the external financial need. Here we have an example. MK associate planning to acquire a machine. The machine will increase the existing sale from 50 million to 60 million. It means having a growth of 20%. The firm believes that its asset and liabilities grow directly with the level of sales. Its profit margin on sales is 15% and its dividend payout ratio is 40%. Means whatever the company is earning, 40% of that earning, net earning, will be paid as the dividend to the shareholder. Will the firm be able to finance growth in sales with the retained earning and forecast increase in the debt? So it is the question. On one side, 60% part of the profit is reinvesting within the business from retained earning. Either the company need any external financing or not. If yes, how much? It is to calculate. Here we have the formula. The external financial need for 20% growth in sales. First of all, assets over sales multiplied by change in sales. Previous sale was 50 million and expected sales are 60 million. So the difference comes to 10 million. minus debt over sales, multiply by change in sale. Thereafter, profit P represents the profit and multiply by projected sales. Projected sales are 60 million, which we have discussed in the previous slide. Multiply by 1 minus dividend. Dividend payout is 40%. Here the figures are also given. Net profit margin is 20%. Dividend payout is 40%. And the change in sale is projected change in sale is 60 million minus 50 million equal to 10 million. Now, here we are going to calculate the external financial need. That is equal to assets. We have the figure for the sales. That is 50. And on the other side, here is our assumption that our assets are equal to 75. 75 million figure for the assets and 50 million are the same. So its proportion is equal to 1.5. Assets are 0.5% greater than the sales. Here debt is 25 and the sales are 50. It means debt is 50% of the sale. On the basis of that data, if we put these values on the above equation, external financial need is equal to 1.5, that is the proportion of asset divided by sale. Multiply by 10. 10 is the difference between the 60 million minus 50 million. On the other side, we have debt is to sale is 0.5 and the change in sale is 10. Minus profit is 20%, projected sales are 60. Multiply by 1 minus dividend is 40. So external financial need is equal to 10 million minus 7.2 million. It comes 2 million and 8 lakh is our external financial need if the company is going to grow by the 20%. Company sales is going to grow by 20%. The external financial need comes to 2,800,000. So you can apply on any balance sheet simply assuming that its sales are growing by say 30% or 40% or even 5% or 10%, and on the basis of its actual figures of asset is to sale, on the other side debt is to sales, profit for the previous and projected sales which you have, and you can check its dividend policy as well. Well, on the basis of those figures, you can recalculate the same calculation and can calculate the external financial need for the business as well. Thank you very much. See you with the upcoming video on the same topic very soon.